Hey, good morning, everyone. Marty Mazzora here. It's Wednesday, the 18th of January, 2023, with your midweek market snapshot. We're going to take a look at the S&P 500 today. Also, we'll take a look at the NASDAQ technicals as well. Before I get going, a couple things. The weekend or end of week economic snapshot and market snapshot that I typically do on Fridays. Those won't happen until very late in the weekend, probably sometime on Sunday. Judging by the latest data this morning, in fact, retail sales, producer prices, industrial production, all indications are that we're going to continue to move further into the red for our general conditions index, which means odds of recession this year are very high by our estimation, which, as we've talked about here, has become largely the consensus among economists as well. In my morning note this morning, I referenced a conversation Nick and I had yesterday just about the concept of reflexivity, right? Which suggests that the stock market, more often than not, actually inspires, if not creates, economic contractions and expansions. So when we start a year like we have 2023, which has been really decent, more than decent for broad averages like the S&P, on an individual security basis, it's been pretty fantastic, and for some issues, and in terms of non-US, which we're very bullish on long term, it's been an exceptional start to the year. So if global equities are going to take off, animal spirits are going to stay buoyant. And that means that consumers, particularly those who own stocks or who are feeling the energy of a higher stock market at least, will go out and spend money. So we're getting, for example, December retail sales right now. Recall that December was not a great month for the stock market. October, November were good, but December wasn't. We still had a good Q4, but December was a big disappointment. So to put it very simply, to some degree, I suspect that folks were feeling the emotions of a somewhat weaker / scary stock market. We're not getting that in January. So it'll be interesting to see next month as we get January's numbers, if this persists, if indeed we won't see animal spirits show up in the retail data, for one example. Which brings me to the point I made in that indeed, reflexively, a rising stock market could, in theory, avert recession this year. However, there's the Fed. And a rising stock market essentially is tantamount to easing financial conditions in what is still, a higher inflationary environment. Now, I mentioned producer prices earlier. Yes, they're coming down faster than anticipated. And again, as I stated, the manufacturing sector is virtually by definition already in recession. The question is going to be at the service level. What are prices doing? United Airlines, I believe it was this morning, gave great commentary on how they're doing and how they expect to be doing in the future. So they're pretty bullish on both consumer and business travel going forward, which kind of flies in the face of some of this weaker economic data that we're seeing. If they're right, the consumer is going to stay somewhat engaged, and therefore, inflation is going to struggle to get down, certainly to the Fed's 2% target. And I think that is what probably my biggest concern is for this current rally, is that I think it is finding its foundation on the prospects that the Fed is going to react to this weaker economic data and pivot, so to speak, perhaps even cut rates sometime in the second half of next year, despite what they're promising. Fed Governor Bullard came out this morning and suggested that that's just not reality as the Fed sees it right here. So this feels to me like it very well could be what we call a bull trap, where it just creates animal spirits among traders and investors, sucks everybody in, only to disappoint them one more time. And we'll get to those prospects and the technicals here in a second. One last note in my monologue here is options positioning. The folks who we pay to give us their expertise and their insights in the options market tell us that there's been a notable amount of support for this market, keeping it somewhat pinned in terms of the S&P around 4,000. Some of that support could go away at this Friday's expiration and into February's expiration. So while they still suggest that the market could kind of grind around here, even grind a little higher, they're noting rising downside risk. Recall in my last technical update, I showed you that chart of the VIX at current levels seems to be where volatility spikes, or it has during this bear market from these levels, and the market tends to roll over. So that would be volatility as it's represented in options pricing, jumping, typically consistent with a market that's declining, perhaps precipitously. So clients, while we're enjoying for our core portfolio, which has been a very nice start to the year, I'm certainly not complaining. We're still hedging. We're still, holding some cash. We like what's happening today for sure in our treasury bond exposure, but we're reluctant to commit much of our new capital here under these circumstances. I believe that we will get there the first half of this year. It could be ideally at lower prices, but it doesn't have to be. It has to be when general conditions all in tell us that the risk reward setup is favorable and odds point to the next bull market being underway. That's just not where we go at this point. So folks, stay tuned. I think playing some defense here continues to make a lot of sense, despite what we've seen so far this year in this very nice rally, and what more and more people are beginning to suggest. More pundits seem to be showing up, I think maybe even influenced by what the market's done lately. That's that theory of reflexivity. Of course, it impacts investors and professionals as well, not just consumers. I noticed the investor intelligence investment advisor sentiment just rose to its highest point of the year. It's not dangerously bullish at this point, but it is certainly in an upswing. And if that continues, then we get to that contrarian point that suggests that the market is overdone to the upside and everybody's on one side of the boat. So definitely stay tuned. Okay, so in front of you is that S&P 500 daily chart, and as you can see, we are dancing above the 200-day moving average right here. Now that's bullish, and bumping our head, or the S&P is bumping its head against this very definite bear market downtrend line. Okay, so recapturing the 20-day and then the 50-day, both of them sloping higher, is technically bullish. Closing above the 200-day moving average is technically bullish, although we've got some pretty strong resistance, as you can see right here, how many times the market has failed against the downtrend line here for the bear market. The reverse head and shoulders that we drew here last couple of presentations continues to play out. The neckline, right, where this shoulder hits the neck and where this one does is that downtrend line. And so if this reverse head and shoulders is to play out the way the textbook says, then we break through the neckline here with momentum, come down, retest it a time or two, and then the next bull market is off to the races. As you know, that's not our base case. Our base case is that this will prove to be a failed reverse head and shoulders, but of course we're open to the possibility that it won't be. It's just that right now our work says that odds favor that it ultimately doesn't work out bullishly this go round. We do expect, frankly, for the bear market to end, and we do expect it to end during the course of 2023. That's our base case, just not yet. When we fold in our momentum indicators, you can see the MACD. Looks like it wants to roll over a little bit here, as does the RSI. Never quite yet got to overbought territory. So that's still not as bearish as, right here. This was the easiest call to make all year in terms of a bear market rally top. And then on the hourly chart, recall last time that I was showing you that was looking very bearish to me. And we did, we broke out of that wedge that I had drawn here, but we just came roaring right back, right? So if I want to redraw my lines here, that's easy to do, right? We have pretty much just a continuation of this bearish rising wedge pattern that we are currently breaking down below. You can see the hourly candle here is broken down below that trend line. That's bearish. We absolutely have these negative divergences, even more so now than we did last time I spoke at you. So yeah, folks, this looks, compellingly bearish to me on a very short-term basis, but we'll see, right? People still seem to be rushing in and buying these dips, particularly on the weak economic data. Although again, market's rolling over pretty good right now. The S&P is down 2/3%, as is the NASDAQ 100. So perhaps the market is now reacting to the combination of weaker data and a Fed who continues to promise us that they're not going away anytime soon in terms of their tightening stance. Okay, and then let's take a look at the NASDAQ 100 index. I'll use QQQ, which is the ETF that tracks the index, just because it's a chart I work on pretty regularly. This is the hourly, same kind of thing. We have that rising wedge, right? And probably even more so than on the S&P, these have been pretty consistent bearish divergences, or at least comparable to what I just showed you on the S&P. So why would we look at the NASDAQ? Well, the NASDAQ emphasizes in terms of its weightings, the Apples, the Amazons, the Microsofts of the world. Now, these are top weightings in the S&P as well, but they're just hugely more concentrated in the NASDAQ. Some strategists look to the NASDAQ first as an indicator of where, the S&P is going because of just general markets dynamics, where people are positioned and so on. So when we look at the NASDAQ 100 on the daily chart, what you'll see is that there's still more work to do. So it has recaptured the 20 and the 50-day moving averages, but it's still quite a stretch to reach that downward sloping 200-day moving average, and we're not yet hitting, the bear market trend line. Now I have two drawn here. Let me just zero in on that one. One is let me back up here a little bit too, just to capture the bear market. One is what looked like the original trend line. We came down here, we rolled over, and then failed right here against the 200-day moving average, and we have these, one, couple, two, three, four hits. So that established the downtrend line. You can see here, resisted it for a few days, and then bolted above it, came down, gapped below it, and it's been resistance, 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 and then lately has, with momentum, has beaten it several up days in a row. Today, right now, is looking like a down day, but again, don't hold your breath just yet. And you can see where we peaked here and then peaked here again, creating now probably the dominant trend line. So technically, this still looks very suspect. Again, this is encouraging in terms of the strength and the momentum of that bounce. But let's just put it this way, there are some serious headwinds above that, technically speaking. I've spoken to the fundamental headwinds. These are the technical headwinds. So if indeed overall market needs the NASDAQ's confirmation, that we're going to continue to move higher from here, there's still a lot of work left to be done. And if we get a big failure here, absolutely unequivocally, we're going to see that in the S&P 500 as well. So folks, I think I can just leave it there. Again, late this weekend, I'll do this again to capture what happens the rest of today, Thursday and Friday. And we'll take a good hard look at economic conditions. And in the meantime, hope you have a good rest of the week. And I'll talk to you then. Thanks as always for watching and listening. Take care. Bye-bye.